You know, for decades, there's been this massive puzzle sitting right at the heart of finance. It's sparked this huge debate between some of the sharpest minds out there. And figuring it out, well, it could change how we think about the entire stock market. So here's the big question, and it sounds simple enough. Why? Why do some types of stocks just seem to earn more than others year after year? We see these patterns, these anomalies, all the time. A classic example is value stocks. You know, companies that look kind of cheap on paper, they've historically run circles around flashy growth stocks. But why does that happen?
For the longest time, the debate has been framed as this two-horse race. In one corner, you've got the rational team. They argue that there's no free lunch, higher returns have to be a reward for taking on more risk. Maybe it's a sneaky hidden risk, but it's got to be there. Then, in the other corner, you have the behavioral finance folks. They say, nope, it's not about risk, it's about us. They think we, the investors, are just predictably irrational, making the same mistakes over and over. And these patterns are just the market taking advantage of it. For years, you basically had to pick a side.
All right, so let's first dig into the reigning champ of financial theory, an idea so central they call it the risk doctrine. And look, the logic behind it makes a ton of sense. In a rational market, why on earth would you get paid more for doing nothing? The only logical reason you'd get a higher return from one stock versus another is because it comes with more of a certain kind of risk, the kind you can't just diversify away. It's a bedrock idea. A higher return must mean higher risk, period. And this isn't some fringe theory. I mean, this is a direct quote from the legends themselves, Nobel laureate Eugene Fama and Kenneth French. They basically said that when we see something like a company's size or its value characteristic linked to higher returns, those things aren't the cause. They're just flags, signposts, proxies that are pointing to some deeper underlying risk that we can't quite see.
But what happens when you stop theorizing and start testing? What if you could actually pit a company's riskiness against its simple, observable characteristics in a head-to-head battle? Well, somebody did just that.
Back in 1997, researchers Kent Daniel and Sheridan Titman came up with this brilliant test. They said, okay, let's set up a horse race. In one lane, we've got a stock's risk profile. In the other, we've got its basic characteristics. Let's fire the starting gun and see which one actually predicts future returns.
So who are the two contenders here? On one side, you have risk, which they measured with a stat called covariance. Just think of it as how much a stock tends to move in lockstep with the big, scary economic risks out there. On the other side, you've got characteristics. These are just simple facts about a company, like its book-to-market ratio. The old-school risk doctrine was betting everything on covariance. So the race is run. The dust settles. And the winner? It wasn't even close. It was a total blowout. When you looked at stocks sorted only by their characteristic, their book-to-market ratio, the high-value stocks beat the low-value ones by a massive 0.70% per month. But when you tried to sort stocks by their risk, the difference was tiny, just 0.24%. The characteristic won in a landslide. Whoa, the fallout from this was just huge. To a lot of people, this looked like a smoking gun. It seemed to prove that a stock's return was tied to its label, its characteristic, not its actual risk. This was a massive win for the behavioral finance camp, and it put the rational risk doctrine on the ropes. But the story doesn't stop there. What if there was a third option? A new theory came along that suggested maybe, just maybe, the entire debate was framed wrong from the very beginning. It's called the investment approach.
Yeah, what if the real question wasn't about investors being rational or irrational? This new approach asks us to look at the whole puzzle from a totally different angle, from the company's point of view.
This theory makes a pretty radical claim. It says, if you want to understand a stock's expected return, don't look at the investor. Look at the company. The answer isn't buried in some mysterious hidden risk. It's sitting right there in the firm's everyday business decisions.
Okay, stick with me here, because the logic is actually super elegant. Imagine you're a CEO. You're going to keep building new projects, right? New factories, new software, whatever. And you'll keep doing it as long as the future profit you expect from that new project is more than what it costs you today. Now here's the key. To figure out that future profit in today's dollars, you have to discount it back using a certain rate. And what is that discount rate? It's the company's cost of capital, which is just a fancy way of saying it's the expected return investors demand from your stock. So boom, the expected return isn't caused by some external risk factor. It is literally hardwired into the company's own investment choices.
Okay, that's a cool idea. But if this link is so direct and rational, let's go back to our horse race. Why did risk get absolutely crushed in that original test? Was the race itself rigged?
Well, the investment approach says the problem isn't that risk is a myth. Not at all. The problem is that we are terrible at measuring it. The risk numbers we used in that horse race were just estimates. They were noisy, blurry, imperfect pictures of a company's true underlying risk.
So the authors of the Investment Manifesto ran a simulation to test this. First, they ran the horse race using the same kind of noisy, estimated risk measures that everybody uses. And what happened? They perfectly replicated the original result. Measured risk had almost nothing to do with returns. It's like the jockey in the risk lane had blurry vision.
But, and this is the absolute kicker, they ran the race again. Only this time, they used the true, perfectly measured risk that existed inside their model. And the whole picture just flipped on its head. Suddenly, risk was a fantastic predictor of returns. The gap between high-risk and low-risk stocks was huge. So it turns out the problem wasn't the horse, it was the jockey. Our measurement tools were just flawed.
And that's not all. It turns out that bad measurement wasn't the only issue with the original test. There were other subtle biases baked in. For one, a company's true risk and its characteristics are naturally tangled up together, which makes them really hard to separate. And second, even something as simple as the order you sort the stocks in, characteristic first or risk first, could totally change the results and make one look more important than the other.
So, where does that leave us? Is it risk? Is it characteristics? Is it all just a big mess? Well, the ultimate takeaway here is that maybe we've been asking the wrong question this whole time.
That classic risk doctrine, we can call that the consumption approach. It's all about the investor's perspective. It asks, what do we need to pay investors to get them to hold this risky asset? But this new investment approach is all about the firm's perspective. It asks what return is already baked into this company's decisions. See, they're not enemies. They're just two different ways of looking at the exact same thing, two sides of the same coin.
So the big aha moment is this. We've been searching for a simple A causes B story, where risk causes high returns. But in the real world, it's more like a complex dance. A company's characteristics, its expected return, and its actual risk are all determined at the same time, all linked together. Asking which one causes the other is like asking if a company's high sales cause its popular product, or if the popular product causes its high sales. You can't separate them. And that leaves us with this final, really fascinating thought. If a company's expected return is just a direct reflection of its own investment and profit decisions, then maybe this whole 40-year quest to find these mysterious hidden risk factors has kind of been barking up the wrong tree. Maybe the answer was never hiding in the complex portfolios of investors, but was sitting there in plain sight all along, right on the balance sheets of the companies themselves.